Hey everyone, welcome to part 2 of our discussion on Motilal Oswal's India Strategy Report 2026. In the first video, we discussed Motilal Oswal's top 5 Nifty 50 ideas and also discussed why Indian markets are struggling in spite of the fact that India's fundamentals remain relatively strong. If you haven't watched part 1 yet, I would strongly recommend watching it first. In this video, we'll focus on their top 5 non-Nifty 50 ideas. These are relatively less obvious names compared to the large cap stocks, but in many cases, they offer more focused exposure to the structural themes like premium consumption, travel and tourism, financialization, and manufacturing. At the same time, these stocks also come with their own set of risk, especially around valuation and execution, which we will discuss in each case. Friends, the idea here is not to chase short-term performance, but to understand how institutional research is positioning for 2026 in an uncertain global environment. So don't blindly take this as buy call. Make sure that you deep dive further before investing your hard-earned money. Alright, let's get started. So first non-Nifty 50 idea is TVS Motors. Now TVS Motor is a classic example of how a company has quietly transformed itself over the last few years. Today TVS is recognized as a technology-driven mobility company with a much stronger product mix. This is clearly visible from company's margin that have expanded year on year, and that was clearly reflected in company's earning growth. One of the biggest strengths of TVS is its execution capability. Company has managed to launch many successful products in the last few years, especially in premium motorcycle and scooter category. Another important tailwind for TVS is the premiumization trend in the Indian two-wheeler market. Consumers are willing to pay more for better performance, design, and features. Then exports are another underappreciated part of TVS story. It has a strong international presence, especially in Africa and parts of Latin America. Then on the EV front, TVS has taken a very sensible approach. Instead of chasing aggressive capacity like some new-age two-wheeler EV companies, TVS has focused on product reliability and gradual scale-up, which is important in a capital-intensive industry. And today, TVS Motor is already leading the two-wheeler EV race with more than 25% market share. Now, if you look at the valuation, TVS is certainly not cheap. Market is already factoring in a lot of positives. It means future returns will largely depend on execution like sustained premiumization, disciplined EV investment, and stable demand recovery in rural market. By the way, in latest December sale, TVS Motor has managed to grow 50%. So the expectation is that Q3 results should be good, and considering the strong demand, TVS should continue to do well in 2026. Overall, TVS Motor fits well into a 2026 portfolio as a quality auto compounder. Not a deep value play, but a business that can deliver steady growth with improving profitability if the broader consumption cycle remains supportive. Second stock idea is Radico Khaitan. Now, Radico Khaitan is a classic example of how a traditionally boring, regulated sector like liquor can quietly create long-term wealth if the execution is right. In fact, Radico Khaitan is one of the biggest wealth creator in last 10 years. The reason behind Radico's outstanding journey is the premiumization trend. Radico moved its focus from low margin mass brand to higher margin premium and prestige brand. Labels like Magic Moments, 8pm, Royal Ranthambore and Rampur have already received global recognition. And new launches are targeted at even higher price point. This shift is extremely important because in the liquor business, margins are driven far more by brand strength than volume. What also works in Radico's favor is the changing consumer behavior. With rising income level, urban consumers of India and even semi-urban consumers are willing to overpay for that premium spirit. Plus, drinking that was earlier considered occasionally has become more of a lifestyle. Another important angle is Radico's asset-light model compared to some peers. They rely on contract manufacturing, which keeps capital intensity relatively low. That helps in maintaining decent return ratio even while expanding into premium category. All these factors resulted in excellent growth in company's revenue in last few years, and operating profits have expanded even higher. On top of this, exceptional execution and brand building resulted in massive re-rating. But from here, I don't expect much re-rating as business already trade at higher valuation. Having said this, Radico Khaitan can still continue to be a strong beneficiary of premiumization trend in alcohol consumption in India and can continue to compound wealth. By the way, some of these stocks are also part of my list that I discuss in my weekly video series. The idea behind this series is not to give a buy-sell call, but share the right knowledge and information that can help you make informed investment decision. Since majority of people have a job or business, it becomes really difficult to spend so much time, and that's where I try to add value. Here I closely track nearly 200 companies along with keeping a close eye on macro events that can help in identifying investment opportunities. For instance, in my last weekly video, I discussed the important Q3 updates by various businesses across banks, NBFC, retail, and various other sectors. But let me repeat, this series is only for serious long-term investors, not for traders. Third stock idea is Indian Hotel. Now, Indian Hotel, which is parent company of Taj Group, is a clean play on India's travel and tourism growth. Interestingly, today the hotel sector is not just limited to luxury travel or foreign tourism. Now, the demand for luxury hotel also comes from domestic leisure travel, weddings, corporate offsites, meetings, conferences, and even religious tourism. Indian Hotel is one of the efficiently run hotel chains in India with a very strong brand name of Taj Group. One of the most important changes in the business model is their shift towards asset-light expansion. Indian Hotel is aggressively growing via management contracts rather than owning the properties. And they have multiple brand categories including Taj, Vivanta, Selections and Ginger. This allows them to scale faster without putting stress on the balance sheet. It also improves return on capital over the long term. Especially if you look at Ginger brand, Indian Hotel is not just catering to luxury category but expanding to mid-scale category and targeting value-conscious business and leisure travel in tier 2 and 3 cities. Here you may argue that the hotel sector is cyclical. So post-COVID, the demand for hotel industry exploded with revenge travel. It resulted in very high occupancy for hotel along with a good price increase. As a result, Indian Hotel witnessed exponential growth in its earning. However, the growth has now normalized. Having said this, even today the demand is higher as compared to the room supply. So Indian Hotel is expected to perform well. That said, let's be very clear that Indian Hotel today command a premium valuation. From here, I don't see scope for valuation re-rating. But as long as travel demand remains healthy and execution stays disciplined, Indian Hotel remains one of the best way to play India's long-term tourism and hospitality story. Then fourth stock idea is Groww. Now Groww is a recently listed IPO and today is India's largest digital broking firm. Groww started its journey as mutual fund investment platform and then expanded to equity broking, ETFs, IPO, FNO and various other financial products. With Groww, Motilal Oswal is betting on India's financialization story and the gradual shift of household saving from physical assets into financial assets. One of the biggest strengths of Groww is its simplicity and product-led approach. Groww has been able to onboard a very large number of first-time investors, especially from tier 2 and 3 cities. That distribution strength itself is a big moat in a market like India. Now, there's no doubt that the opportunity for Groww is quite big. The biggest tailwind for Groww is the structural rise in equity culture. SIP inflow continue to remain strong, Demat account penetration is still low relative to India's population, and younger investors are far more comfortable using apps like Groww to manage their money. Having said this, today Groww already commands a market cap of around 1 lakh crore with high valuations across price to sale and price to earning. Now, if you compare it with other competitors like Angel One, Groww valuations are too high. The only question is it worth paying such high valuation to Groww? On that, you have both arguments, in favor and against. Those in favor of Groww premium valuation argue that it is not a traditional broker. It is a platform play on India's long-term financialization theme. Groww has built a large and sticky user base, especially among younger and first-time investors. And when users start investing through one platform, they tend to stay. And that's valuable customer retention. Then Groww can also benefit from cross-sell opportunity. Users can start using Groww for mutual fund or stock investment and they can participate in IPOs, explore ETF and potentially move into other financial products. This increases the revenue per user without proportionate acquisition cost. Since Groww is platform company, over time, as the revenue increases, it won't increase the cost in the same proportion. So a lot of that revenue would directly flow into the profits. On the other side, investors who are cautious, they argue that Groww's core revenue still come from brokerage and brokerage earnings are extremely volatile. While earning grows at much faster rate during bull cycle, which is clearly reflected in Groww's revenue and earning growth in last 2-3 years, but it can also fall sharply during bear cycle. Currently, markets are in negative territory, so investors should keep a close eye on how Groww performed during difficult phase. Also, Groww's profits have been volatile in the past, so investors should keep a close eye as Groww's profitability has not been proven yet. Next point is India's broking and investment platform space is now very crowded, with Zerodha, Upstock, Angel One, ICICI Direct and many other players competing for the share. If competitors cut prices or increase incentives, Groww's margin could be challenged. And last argument is brokerage and financial services are highly regulated. Any negative impact in regulation can impact Groww's revenue and profits. Now you need to decide which side you fall into. Are you bullish or you feel that Groww's valuations are too high? But Motilal Oswal team is bullish on Groww for 2026. In case you want to deep dive further into Groww business, I've done a detailed video. Final stock idea is Dixon Technology. Now, Dixon is India's top consumer electronics company and has been a massive wealth creator in the last few years. However, there has been a sharp correction in its share price in recent past. We have already discussed this in detail recently. Now again, investors are divided on Dixon. While everyone agrees that Dixon still has a long runway for growth, but the argument is only on valuation. Dixon has always commanded a premium valuation in the past due to its high growth. But with recent correction, PE has fallen significantly. However, some investors believe that Dixon valuations are still high. Their argument is, while EMS sector in India certainly has high growth potential, it is not completely risk-free. First of all, Dixon margins are paper thin, which is clearly visible in its P&L. Then customer concentration is high and business is sensitive to policy changes. Any slowdown in PLI benefit or delay in customer order or aggressive pricing by clients can hurt the profitability. Also, electronics manufacturing remains competitive globally, so execution needs to be tight every single year. Also, the argument is Dixon was able to grow at much higher rate due to its small base in the past, but now it has a top line of 48,000 crore. From here, it would be difficult to grow at 40-50% historical rate. On the other side, some investors argue that after the recent correction, Dixon valuations have normalized. Indian electronics sector has huge runway of growth. As global companies diversify supply chain away from China, India is emerging as a credible alternative and Dixon is already one of the few scaled, trusted EMS player. Plus, the Indian government is clearly focusing on Atmanirbhar Bharat. Today, Dixon is already present in mobile manufacturing along with consumer electronics like TV, washing machine, lighting products and security system. It is also expanding into IT hardware, wearables, telecom and automotive electronics. So the scope of business is quite big. Plus, backward integration is a big opportunity for Dixon where it can move from pure assembly to component manufacturing. Again, you need to decide which side you fall into. Motilal Oswal research team is bullish on Dixon and consider it a top conviction bet for 2026. So if you step back and look at all these non-Nifty 50 ideas together, Motilal Oswal bets are largely on businesses where the structural story is intact, execution quality is visible, and the next few years can still deliver reasonable earning growth despite near-term volatility. TVS Motor is a play on premiumization and disciplined EV execution. Radico Khaitan is a long-term beneficiary of premium alcohol consumption where brand strength matters more than volume. Then Indian Hotel is about India's travel and tourism demand growing structurally, supported by asset-light expansion. Then Groww is a bet on financialization theme where valuations are high but the opportunity size is also large. And finally, Dixon is all about India's manufacturing ambition where execution matters more than narratives. What's also important is to understand that most of these stocks are not cheap. The market already knows these are good businesses. So future return will depend less on valuation re-rating and more on earning delivery and execution. This is where patience becomes important. These are not stocks where you expect straight line return every quarter. And finally, just to repeat, this video is not about buy or sell call. The idea was to share how a large institutional research house like Motilal Oswal is thinking about 2026 and what kind of businesses they believe can navigate uncertainty better than others. You still need to do your own work, understand valuation, assess risk and decide what's fit your portfolio and time horizon. Now tell me in the comments which stock idea you find most promising for 2026. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.